Imagine waking up one day and banks are collapsing, people are losing their homes, and the entire global economy is in turmoil. That's basically what happened in 2008, the biggest global financial crisis since the Great Depression in 1929. Within months, stock markets plunged, major companies disappeared, and millions of people around the world lost their jobs and livelihood. Governments had to step in with emergency measures just to keep the financial system functioning. But this crisis didn't appear out of nowhere. It had been building for years. So how did it actually happen, and why did things spiral so badly? Let's break it down in 6 parts. In the early 2000s, buying a house in the United States seemed like a guaranteed win. Real estate prices kept rising every year, interest rates were relatively low, and banks were eager to lend money. So much so that many of these loans were given to people with low incomes, unstable employment, and poor credit histories. These were known as subprime mortgages, and many of these mortgages had features which made them highly risky, like adjustable interest rates that started low but could jump dramatically after a few years. But at the time, this didn't seem like a huge problem. The assumption was simple. If someone couldn't afford their mortgage later on, they could just sell the house at a higher price and cash out, because house prices kept going up. Or at least, that's what everyone believed. Here's where things started getting more complicated. Traditionally, when a bank gave someone a mortgage, they would keep that loan on their books and collect payments over time. That meant the bank had a strong incentive to make sure the borrower could actually repay the loan. But in the early 2000s, a different system became popular. Banks began bundling thousands of mortgages together and turned them into investment products called mortgage-backed securities, also referred to as MBS. These securities were sold around the world to pension funds, hedge funds, insurance companies, and even to other banks. The idea was that homeowners across the country would keep making their mortgage payments, and investors would receive a steady stream of income from those payments. The problem was, financial institutions didn't stop at MBS. They went further by creating more complex products called collateralized debt obligations, also known as CDOs. These were effectively a bundle of various debt assets, such as mortgages, bonds, and loans, packaged into a single security, which was then sliced into different layers or tranches of risk and sold to investors around the world. To simply understand this, imagine this cake is a CDO. The bottom tranche is the riskiest but offers the highest return. The mid layer is medium risk and reward, and the top layer is the safest, but with the smallest returns. So if homeowners stopped paying, the bottom layer investors would lose money first, and the top tranche would lose out last. So in theory, investing in the top tranche seemed fairly safe, as the assumption was that only a small number of mortgages would default at the same time, meaning the top tranche would remain mostly protected. And for that reason, credit rating agencies gave the top tranche a AAA rating. In other words, they were rated as extremely safe. As a result, these securities became very popular across global financial markets. But there was a serious flaw. Many of the mortgages inside these CDO and MBS bundles were extremely risky, and the true level of risk was not fully understood. Also, if you haven't seen this scene from The Big Short, then I'd highly recommend it. It explains how CDOs led to the downfall of the American housing market, just like a game of Jenga. Link to the scene is down below. Around 2006 and 2007, the housing market began to change. House prices stopped rising as quickly, and in some areas they actually started falling. For homeowners who had bought houses at the peak of the market, this created a serious problem. Many people suddenly owed more on their mortgage than what their home was actually worth. This situation is called being underwater on a mortgage. At the same time, many adjustable rate mortgages began resetting to higher interest rates. Monthly payments jumped, sometimes by hundreds of dollars. For families already stretched financially, those higher payments became impossible to manage. Mortgage defaults started increasing across the country, and those so-called AAA investment products also started losing money, and these losses started spreading through the entire financial system. Once investors lost confidence, the situation escalated very quickly. Banks and financial institutions began reporting massive losses tied to mortgage-backed investments. Some firms wrote off billions of dollars in value almost overnight. As uncertainty spread, banks became reluctant to lend money even to each other, and this created another problem, as the global financial system depends heavily on short-term lending between institutions, and when that lending slowed down, the system began to seize up. Then came one of the most dramatic moments of the crisis. In September 2008, a major investment bank, Lehman Brothers, collapsed after failing to secure a government bailout. This bankruptcy shocked global markets and triggered widespread panic. Stock markets dropped, investors rushed to pull out money from risky assets, and credit markets froze, making it difficult for businesses and consumers to borrow money. Some of the largest financial institutions in the world were suddenly on the brink of failure. What started as a housing problem had now become a full-scale global financial crisis. Businesses now struggled to get loans, which meant many companies had to cut costs quickly. Layoffs increased and unemployment rose sharply in many countries. With increasing unemployment rates, a staggering 3.1 million homeowners in America filed for foreclosure. To stabilize the financial system, governments and central banks had to step in. The US government introduced the Troubled Asset Relief Program, which provided billions of dollars to support struggling banks and financial institutions. Central banks also cut interest rates and injected large amounts of money into the system in an attempt to restore confidence and encourage lending. Despite those efforts, the global economy entered into a deep recession. Recovery took years, and in some countries the effects were felt for more than a decade. In simple terms, the 2008 financial crisis happened because of a combination of factors: high-risk mortgages, complex financial products, overconfidence that house prices will continue to increase, and a financial system with inadequate controls and regulation. When the housing bubble burst, it exposed these weaknesses all at once. The result was one of the biggest economic crises in modern history. But the crisis also left an important lesson. Sometimes it just takes one falling domino to ripple through an entire system.